Okay, good afternoon all, and welcome to our May BizVal webinar. I'm Graham Stephen, the co-founder and CEO of BizVal, and today I'm speaking live from London, even though if you look at my background, it's my hotel room back wall. And once again, I'm joined by my co-founder, the Finance Ghost. Today's webinar is themed a global view on valuations, and we're thrilled to be joined by Jodilee Manuel and Duran Hammer, pronounced Duran style, from Syft Analytics. And more on them a little bit later when we'll give them an opportunity to introduce themselves. So I'm in London to attend Accountex this year, and it's one of the largest global accounting and supporting ecosystem conferences in the world. And the reason we're here is just to connect with our partners, service providers, and to remain sure that we as BizVal remain up to date and relevant in terms of how we develop our product on the global stage. So what's really struck me being in London, I guess for the first time in over 6 years, is how inflation has really hit the UK hard. The UK has traditionally been a very stable, low inflation rate economy, but as of late, it really seems to have been impacted by high and sticky inflation. And I think what's really interesting for us from a BizVal perspective is the UK has traditionally relied very heavily on revenue and profit multiples when they value companies. These sort of rule of thumbs around, 3 times profits or 3 times revenues. And I think, what's really important to realize, with the sort of global lens on, is how sensitive valuations can be to things like discount rates, the time value of money, and these things are impacted by inflation. So when inflation is higher, investors tend to demand a higher return, and this puts pressure on valuation. So it makes it harder for businesses to actually achieve the value they want when they're selling, and it can lead to a disconnect between their expectations and reality. So I think it's important, to look through the cycle and, give both buyers and sellers a really sensible view. So that's kind of been one of the key takeouts that I've had after being in London for the past few days. So I think in today's webinar, the Finance Ghost, to give you a rundown, is going to give you our view on our valuation model, and particularly through a sort of the global valuation methodology and how that applies. And then we're going to be having a really cool panel discussion with the Syft team on how effectively using analytics can actually add value to the process. And again, the theme today is a global view on valuation. So we're not just talking South Africa, we're talking globally and how this is relevant. So before I hand over to the Ghost, just some quick housekeeping. I think we had a great attendance today. I think we've had over 200 registrations, but obviously in South Africa with load shedding, I'm sure not all of those will attend, but thanks to those of you who are here. The Ghost is going to have a short presentation, then the panel interview, and then the floor is going to be open to any questions from our audience. So please feel free to send questions whenever you like in the chat. For those of you who've been with us before, the chat settings are set to private, so only the moderators and the presenters can see the questions. But what we do tend to do is kind of, repost any questions that come through. Don't wait till the end of the session. If something comes up, put the chat in the message. We might just get to it in the flow if it's relevant, or else we'll hold that over to the sort of formal Q&A section. And then lastly, we recording the webinar, so it will be made available on YouTube. If something comes up, you need to drop off the call, feel free to go and watch the recording a little bit later. Then finally, just in terms of our poll, for our regular attendees, we do have a poll running. Just help me while I navigate my screen here. Before that, at our last webinar, we asked the question, what area of due diligence process on your business would you worry about the most? And interestingly enough, 56% of those who answered said financial. Okay, so I guess that is a bit of a segue into today's topic, because we are focusing quite heavily on some of those financial aspects and how we report on those. It was followed closely by sort of legal and market analysis, but those results are there. Today's poll, the question is, how do you use accounting information in your business? I don't really. I watch the cash, decision making, and compliance is behind. I have both management and financial accounts, which are both up to date. So take a minute, answer the poll, and without any further ado, I'm going to hand over to the Ghost.
Thank you, Graham. Thank you, everyone, for attending today. Graham is in London at the moment, as he told you, so that's a place where coronation is an event rather than an asset manager with a tax problem. So that must be quite fun, also quite cool to be far away from load shedding. So Graham's getting a very different experience to the rest of us down here. It's amazing to see the impact on the load shedding has on the number of people who actually attend the live event, but it's good to see so many of you here. So please bring those questions through as and when you feel like you've got something to ask. So I think, Graham, if we can move past that partners slide there with Syft nice and center, and you'll be able to engage with that team just now. What I will be talking to you about today is just a bit of a roadmap on how we actually go about our valuations. And I'm not planning to take up the whole session for that, I promise you. But I think it's quite useful to just run through how a valuation actually works. The word valuation just gets thrown around all the time and very loosely. It's one small word, and yet it describes such a detailed and technical process. And we've tried to obviously simplify it as much as we can in Bizwell without losing our goal overall is accuracy. And that's actually something I need to stress first before before that little car goes on that road. We don't claim to give a perfect valuation because there's actually no such thing. There's a lot of professional judgment that is required in that process, which is why there is a range rather than a perfect answer. So this is why we've gone and developed a methodology that strives to actually find that range or to get as close to it as possible. And the idea here is obviously to help SMEs get access to a professional valuation service that has generally been unaffordable in the market for as long as any of us can remember. Now, you'll have to excuse the useful roadmap here because all of the founders of this business are petrol heads. And the road trip starts with actually getting to know your business. And that's not just because we are curious or we want to stalk you, but because this stuff is actually really important. We need to know about your legal structure. We need to know about how old your business is and where it is for that matter. We want to know how many employees you have, what sector you operate in. And the reason we want to know this stuff is because this is the starting point for the discount rate for your future cash flows and some of the other adjustments that we make to the valuation for your size, for your age, for example. Valuations are incredibly sensitive to discount rates. If you've been following listed equity markets over the past few years, you will have watched share prices react very strongly to macroeconomic volatility. And that's mainly a result of inflation and yields and those sort of inputs into a valuation above all else. So this stuff is very important. And, on that note, and it's something Graham alluded to, and he's seen it now in London, having not been there for a few years, inflation is obviously incredibly intense at the moment. We all know this from just going to the shops. It's very volatile, and interest rate expectations in the market are changing drastically almost overnight. Last week we saw big non-farm payroll numbers out of the US. That kind of changed the narrative again and put us back into the territory of, could there be further rate hikes potentially? Just a few days prior, it was more of a talk of recession, and you've seen what's been happening to the gold price. So no one really knows, despite what they may claim. And that's why we take a through the cycle view that we think a financial investor would take. Obviously, we update all of the inputs in the model that are impacted by region, etc., as and when the macroeconomics change. But again, we're not looking to make every tiny change because they are highly volatile. We're looking for sensible numbers for inflation and for yields that aim to find what is ultimately a reasonable valuation range. The next section we get into becomes very specific to your business, and that's how you actually make your money. So that's on the income statement, and we want to know about your revenue, your gross margin, the split between goods and services, and obviously your customer dependency. Now, we covered that in a previous webinar at one point about how to build a more valuable business. And having a broader range of customers is good for evaluation because ultimately it reduces the risk in your business. If we go to the next slide, Graham, as we drive along this little road, we then get to how you actually spend the money that comes into your business. So, to borrow a golfing term here, it's revenue for show and profit for dough. We need to know about where the money is actually going. And we also need to attempt to get normalized profit, not just the profit that you are reporting. This is especially true in SMEs, where you often have a scenario where, the CEO is not necessarily paid a market-related salary, or where the company owns a property rather than pays rent. And people forget to then allow for rent in actually valuing the operations of the business. So this is the kind of stuff that we focus on there. We then move into working capital. And if you've never come across the term, working capital is essentially just how the cash moves from your income statement into the balance sheet. And it gets caught up in various things along that way. Debtors, creditors, inventory, and of course, some of it lands up where you want it, which is in excess cash that you can use to pay out a dividend, go and do an acquisition, pay down debt, whatever it is you're looking for. Businesses that are more efficient at turning profits into excess cash are also more valuable. So it is important to understand what happens to those profits and what the working capital profile of the business actually looks like. And Graham, if you can go to my last slide today before we hand over to the Syft team, we then get to the balance sheet. And this is the rest of the balance sheet because working capital is on the balance sheet as well. So this is specifically stuff like property or debt owed to third parties. We also ask you what you pay in interest on that debt. It's a little bit technical today, I think, but the way we actually use the valuation tool is we go and deduct today's value of debt from your value, as opposed to trying to forecast how your debt might move over years to come on your balance sheet and how you service interest, etc. That becomes a little bit too complicated for an online valuation tool like this. So where we ask for the annual interest rates, it's actually incredibly interesting to see what businesses are paying on their debt. And where we see something that is out of kilter, we then actually have a closer look at the risk in that business and whether or not we think the valuation is actually coming out in much the sort of correct range. From there, we move on to some natural language questions that make our model quite interesting, I think. And the first one is fairly obvious, which is, what is your growth expectation? Now, in any valuation in practice, the management team will give a view on growth, and a buyer of the business will place a lot of dependence on that. Sometimes they'll go and structure an earn-out around it. We've covered that in previous webinars where we've talked about due diligence, for example. Our model obviously cannot immediately audit what you think your growth rate is going to be. That's unrealistic. It requires people to give a realistic view of growth, both near term and mid-term as well. So that's really important. And we use that in our discounted cash flow. We use it in our earnings multiple methodologies as well when we look at an exit multiple, which is how private equity investors tend to actually look at the world. And finally, then we get to the phase of the business, because a startup, for example, has a completely different risk profile to an established business. And I think a point we need to make there is we don't value pre-revenue startups. If your business is still on a whiteboard, then this is not going to work. That's a completely different way of doing things. That's very much angel capital. Ours works provided you have a business that is making revenue. You've got some view of profitability. It doesn't have to be profitable right now, but there is a route to profitability. And if you aren't quite sure if your business is ready for a BizVal valuation, obviously, reach out. We would be happy to then have a look and actually, tell you our thoughts on whether or not it would work. I think having done that sort of fly through of how a valuation works, and keen to obviously take questions later, I'm going to hand over to the Syft team now. So Duran and Jodilee, I'm not sure which one of you will go first, but I'll leave it to you guys to introduce yourselves and to tell us a little bit more about Syft. And then I'm very keen to get into a panel discussion Q&A.
Brilliant. Thanks, Ghost. Thanks, Graham. Appreciate you guys having us today. Jodilee, maybe you want to introduce yourself first there. I see you at the top of the slide.
Okay, sure thing. My name is Jodilee Manuel, and I'm head of education and implementation at Syft. I come from an audit background, and I joined Syft about a year ago. And my main kind of goal is making sure people know how to use the software and how to get value out of it for their business. And we also work a lot with universities. Forgot about that's my passion project, because we've also noted there's quite a gap between what students learn at university and what they need in the real world. So we're also working towards bridging that gap.
Great, thanks, Jodilee. And hi, everyone. My name is Duran. I'm one of the co-founders at Syft. My focus is on the revenue side of the business, very much at the start of the funnel. So how do we grow our sort of leads into the funnel through different partnerships and different channels, and then ultimately convert that into, I guess, paid clients. And so my background is actuarial and analytical in nature. And I guess we're super excited to join the conversation today and I guess share some of our insights and some of the conversations that we're having with our clients around the world. So, I mean, Syft as a tool itself is really a reporting and analytics tool for financial data. And essentially what that means is that we take all of your financial data from various sources. And, as an example, it would be accounting platforms, specifically cloud accounting platforms. We'd bring that into Syft, and we would help business owners, accountants, bookkeepers, any consumers of that financial information really understand and analyze that data by playing it back in a nice visual, easy to interpret manner. But ultimately, the intention is that any interpretation that we do on the tool is to help business owners make better decisions in their business. And I think that's what we're really passionate about, is how do we, this for us coming from consulting backgrounds and auditing backgrounds, is that, we often see analytics being used in large corporate institutions. And for us, it's around, how do we find, or how do we drive value for smaller businesses in particular, and show them and kind of walk the journey with them, the value of analytics and how they can make decisions off that data and ultimately grow the value of their business, which I guess is really the core of the conversation today. So at the moment, I mean, as some of the guys alluded to at the beginning, this is a kind of global conversation. So although we are a business based in South Africa, we serve clients around the world. So I think we probably have clients now in around 80 different countries, primarily focused in the English-speaking territories. But we serve a large accounting and bookkeeping base, who obviously in turn also then serve businesses or business owners at the end of the day. And we also deal directly with businesses. And so I think, serving both types of customers, we have been involved in a lot of conversations around valuations, what are some of the key drivers of value in businesses, and, helping guys understand what value lies in their data. And that's really just a light intro to our business.
Fantastic, guys. So maybe just before we go into the questions, if you want to find out anything more about Syft, if you click on the handout section, you'll see, in addition to our newsletter and that, there are a couple of handouts around Syft, so you guys can go click on there and download that and read through that at your leisure. So guys, I'm going to hand over to you to kind of lead into some of the questions for the Syft team, and let's go from there.
Thanks, Graham. Thanks, guys. So to the audience, please do send through your questions. It can be on pretty much anything. We'll try and answer it as best we can. I've got a couple for the Syft team already while we wait for some of those questions to come through. And I think, South Africa at the moment is a little bit doom and gloom, let's be honest. Eskom certainly doesn't help, and I think a lot of South Africans are trying to figure out how they potentially build a business that kind of goes overseas or diversifies offshore, whatever the opportunity might be. Syft has done that extremely successfully, and I thoroughly enjoyed a podcast that I held recently with Vangelis, the co-founder and CEO of the business, and I would encourage people to go find that on the BizWell site and listen to it. We talked a lot about how Syft was built and taken overseas. It was great. But the question for the two of you is, what is the opportunity for business owners in South Africa in the current global marketplace, in your view?
Duran, I think you best.
Yeah, thanks, Ghost. Cool. No, I think that's a great question, and it's often something that we reflect on with a lot of people overseas, and maybe some context before we answer the question, and some of the challenges that a lot of our clients, both accountants, bookkeepers, business owners overseas, are facing is that the key challenge for them is around finding good talent in the market. And so there is a massive shortage of available skills in the market. There is also obviously a significant cost attached to that. And it's almost become rather than an employer's market, it's sort of an employee's market. And, for us, I think in South Africa, it's kind of still the reverse. And so we have access to a significant or broad base of skills that are hardworking. So I think South Africans have got a hardworking culture. Obviously, that abundance of skills, English speaking, I guess well positioned geographically as well to kind of serve multiple territories. And so for us, the thinking has always been, how do we create a back-end capability or an execution function in South Africa that can still serve a global client base? And I think that's really what Syft is. Essentially, our sale, we run everything here from HQ in Johannesburg. And, we continuously getting new talent. We really don't have a shortage there. And I think that is our biggest advantage. And speaking to a lot of other business owners and influential people that we've met over the years, is I think the businesses that will succeed in South Africa will be the ones that understand that model. That, South Africa can be an outsourcing platform. We can be a back end for a ton of businesses. And that is our key advantage. I think the market from a selling point of view is quite small, obviously versus all of the other markets that we play in. And so the thinking or the challenge, I think, is to think of a global product, but everything from a fulfillment, product development, back-end perspective can be performed and executed in South Africa.
Yeah, super interesting. It just shows you there's always an opportunity. You just have to actually figure out what that looks like. And speaking of opportunity, I'd be curious to know from a Syft perspective, any lessons or, what you've seen on the ground, any of your clients perhaps in terms of how they go about evaluating opportunities, scope for growth, not just here, but abroad as well?
Jodilee, you want to
I'm just thinking
have a go?
what answer for that one. So I think when I was speaking to a lot of people overseas, in like the UK and Australia mostly, I think the challenges we face are pretty similar. So it's like costs, inflation, like Graham mentioned earlier, and like cash flow. So I think knowing kind of where you are and having a good understanding of your numbers can help you plan for those opportunities. I think often we think we know how well our business is doing, but if you, like, for example, in Syft, we have a cash manager tool, which like predicts your cash flow. So then you can say, in a few months' time, I'm going to be short on cash and I can plan better, or I'll have surplus cash so I can go and look for an opportunity to use that. So I think knowledge is really power, and kind of knowing the numbers in your business can really help you make the most of opportunities that come your way.
Maybe to jump
and I think maybe just to add,
Jodilee, I mean, one of the things you guys do really well is you visualize those numbers. So, you spend a lot of time and energy on making the numbers look pretty, so to speak. Can you just talk about how important that is? Maybe, the global lens on, how imagery and presentation can actually help people understand numbers better.
I think visualization for me, it's so much easier to tell a story with a picture. And especially, I was at the university last week and I was explaining what we do to the students, and they're studying 4-year accounting degrees to understand these complex financial statements. And often business owners are really good at business, but perhaps they don't have such a deep accounting background, but they still need to understand what's happening in their business to go and make good financial decisions. And so a lot of our clients who are accountants will use these visualizations of, this is what your profit's looking like, this is your income and expenses, all those different visuals to make it easy for business owners to understand what's happening in their business. And I think, it just helps you understand quicker and see, anomalies and trends, and all of that's really useful in making decisions.
Duran, you wanted to add
I think
something?
maybe also just to...
Go ahead.
Yeah, thanks, Ghost. I mean, I just back to the question of growth and opportunity. I think there's obviously the whole, I guess, house cleaning and understanding your data, so the aspects that Jodilee was talking about. And then I think something that's maybe a bit of a topic that comes up often, but is maybe not explored enough at I guess, a smaller business level, is this idea of benchmarking. I've looked at my financials and I'm good at, I've managed my working capital well, I'm growing nicely, but, how do I stack up to the rest of the market? What is everyone else doing? Is there opportunity to do better? And I think that's also part of the journey that we're trying to take, our clients on at Syft, is to help them understand, where they stack up versus their peers in market and globally. And then almost sort of build a financial storyline from there to say, well, what are all kind of the levers that I have along the way? So for us, everything kind of fits nicely into a decision tree. So if you think about sort of the starting point is, I'm a business in a particular sector, I know my financials, but how do I stack up to everyone else, let's say in my same region? So I'm a business in South Africa in the retail sector. What are all my other peers with similar turnovers look like? What does their cost to income ratio look like? How good are they at managing their working capital? And then working your way down that decision tree. So maybe I have a revenue challenge, or I have a cost challenge. So kind of working your way through. And I think that's really the beauty of our platform, is that there's a lot of things that you can do inside the tool, and there's a lot of analytics, but it's how do you all pull it together in a coherent storyline that makes sense. And also you can always kind of test that you are trying to achieve your objective. So for me, I think benchmarking is hugely important, and always good to kind of think, even though you might think you're doing well, how do you stack up versus everyone else kind of around you?
Yeah, I like that a lot. And it kind of, talks to a couple of questions that have come through around, to what extent can you give data to businesses to help them benchmark against other industry players, etc. And I know that is very much part of what you guys do. There's been a request here to see some examples rather than, necessarily just talking through it. So what I would suggest is, to those who want to know more specifically about the Syft platform, there's obviously some interest peaked here. Like, go check out the Syft website. There's an enormous amount on there. Reach out to the team. What we wanted to do today is kind of just bring together this importance of the Syft platform and the way that data is used in these decisions, and then some of the valuation stuff as well. And there's a couple of valuation questions that we need to get into as well. But there's clearly some interesting what Syft is doing. So go and check out the Syft website. I've been on it myself. There's loads on there. And I think I'm going to jump into just a couple of the valuation questions that have come through so far. So I'll take these, I guess, but Graham, jump in, or to the Syft team, feel free to jump in. But the one question is, how do you scrutinize forward-looking assumptions in valuing a business in an industry where you may not necessarily have the expertise? Now, I kind of alluded to this when we went through the roadmap, and this is how it works in practice. And, we've tried to build the tool to reflect how it works in practice. But when financial investors are looking at a specific business, they will obviously have a chat with management and say, listen, what do you think is possible? And on what basis? What does the business plan actually look like? And then obviously a lot of common sense and just commercial wherewithal is added into this mix by looking at what the business has historically achieved, assessing the plan to say, is that reasonable, yes or no? And then what will happen is financial investors will either say, no, that's nonsense, and they'll just haircut that plan accordingly and actually bring the valuation down. Or they might say, okay, cool, that's interesting, this looks really good, but we're going to put an earn-out into the structure. If you hit these big audacious goals, wonderful, you get paid. If you don't hit them, we're not taking risk on that. So in our valuation tool, it's very much a case of obviously the inputs that come into it need to be a sensible expectation of growth, specifically for BizVal Live, which is very much an online tool. Obviously, when we do a concierge with clients or we do a boot camp with clients, then we're having a deeper look. We're spending some time with them. We're getting to know what's in the business. We're having a deeper look at the financials and what's happening there. And then we can start to get a little bit closer to a more accurate valuation range. And we actually had a really interesting chat as the founders the other day, and we sort of came up with this concept. It's almost like a dartboard. And if you can imagine, online BizVal Live as being your first stab at the dartboard, you're probably kind of hitting around the edges. You're on the board, but you're not at the bullseye of what that valuation is. And as you move through it and you do a concierge and you learn a little bit more about we learn a bit more about the business, you learn a bit more about the valuation process, we get a lot closer to actually a more accurate valuation range. Having said that, it's amazing how often the BizVal Live tool actually gives an answer that is very close to where we end up anyway in concierge or as a reasonable valuation range. But of course, if you're going to go on and use the tool and just put in, crazy growth numbers, you're going to potentially get a crazy answer. So put in growth numbers that are defendable, because if you're going to use that outcome in any of your negotiations with someone or in just seeing how you're doing, it's definitely not in anyone's interest to use numbers that are not realistic ultimately. I just want to move. Yeah, Graham.
Maybe I think Duran did touch on that a little bit earlier, but specifically around industries, where we perhaps don't have experience. I think, Duran, the point you made around, having some of that aggregate data from a Syft perspective is really, really interesting. So maybe you can just share a little bit quickly, as Syft users, how you can perhaps benchmark yourself, how that process works, and are there filters and opportunities to do that across different industries and sectors?
Yeah, I can touch on that.
Yeah, absolutely. Okay, cool. Go ahead, Jodilee.
So we have a benchmarking tool, and I saw someone in the question said, with all the entities we have on Syft, do we have benchmarking? So yes, we do. So all the entities, we pull through the data. It's then obviously anonymized, so you don't know which entities you're comparing it to. But you can select either like a sector or a smaller industry, and it will tell you you're comparing to 10 bakeries in your location. So it'll be based on location and sector. And then we have these visuals where you can see that in terms of number of sales. So we look at activity and financial aspects. So we look at your currency value of revenue, but also the number of sales and things like that. So you can see, are you managing your costs better than them or worse than them? So you can see in each aspect if you're ahead of them, on par or trailing. And the idea is that you can then go and say, well, they can go sell so many more items than I can. How can I kind of reach that? And then if you work on those aspects where you're trailing, and obviously see where winning in the aspect and try strengthen those, then you should be able to grow your business and add value.
Great, thanks, Jodilee.
There's a question here about how we pick a valuation discount rate for a specific business. I quite enjoyed the example given, which is a gardening business. I like it. So very much from SMEs all the way up, and I like that because that's any of these businesses. Well, they don't all have value, obviously, but a lot of businesses do, of all shapes and sizes. So I think the important thing to understand here is when you are valuing a business and you're thinking of a risk premium, et cetera, at the end of the day, what you're actually doing with that discount rate is you are trying to figure out what the required rate of return is that an investor would want from that business. Now, if you go and look at a lot of the industry data, etc., what you would typically do in South Africa is you would take kind of the 10-year government bond rate, you would add about 5.5% as a spread for an equity return, and then you would kind of adjust the listed company for whether it's sort of more or less risky than the average market play and come out at an answer, which is why some listed companies trade at much higher multiples than others, because people see them as so much more defensive. For example, at one extreme, you might have Clicks, which is very defensive. At another extreme, you might have a junior mining business, which is super risky. The required rate of return for those two businesses is completely different. In private companies, and certainly what I've seen in practice, and again, this is a very, I suppose, South African answer in this case, because that's the region in which we've grown up, but the principle is not different anywhere else. Private equity investors look at a business and they say, okay, gardening, that's fine. How big is it? What is the risk? Is there succession if, the owner has a terrible incident with a pitchfork? Is there someone else who can carry on with it? What is the history of this business? How many customers are there, et cetera, et cetera, et cetera. But generally speaking, they are looking for an equity return of somewhere above 20%, and then it varies. It can go all the way up to 30%. We've done concierges where it's even higher than that because the business is very, very risky for whatever reason. And by the time you're finished with that valuation, you come out with a business that is trading on a multiple, sometimes of only 3x. And you think to yourself, oh, that's really low. Look at that listed company. I would point out to you that there are listed companies right now. Calgary M3 is trading on 2x, just for the record. There are listed companies that are, lots of them, that are trading on 5x or 6x. So 2x or 3x in practice, just think about what that means. A small business is making a net profit of 2 million Rand. That means someone is paying the business owner 6 million Rand and taking all the risk of how that thing behaves going forward. It's very easy to make 3x not sound like a number until you actually have to put your own money down and say, oh, I'm paying for 3 years worth of profits in advance in the hope that that works out. And then suddenly it's a little bit scarier, rightly so, than buying shares in Clicks, for example, or any of the other listed companies. So that is how we work these risk premiums, is we look at benchmarking industry data. We look at the macroeconomic stuff, like the 10-year bonds, for example, in that country of operation. We look at all the questions we ask up front, how many employees are there in the business, et cetera, how long has it been around? And then we've kind of developed the methodology to have relatively standardized adjustments that we make. And then obviously we do a lot of quality control around the stuff going through our live tool. And we have a look, and Graham checks every single one. I often have meetings with him where we look and we go through it and we work through and we figure out if this is right. And it is, generally speaking, it comes out at very reasonable levels. And we get a lot of feedback from users. What we often find is people are just curious to see where we come out. They've got an evaluation already. I always love the curiosity of users. They go and do one with us anyway. And they come back and say, wow, that's interesting. This is within 5% of what we got from, this detailed long process we went through with an audit firm somewhere or with a professional advisor. And that's fine. The detailed process is important. Our stuff, I'm glad to say, comes out pretty close. So hopefully that answers the question around valuing a gardening business. I enjoyed the example. It sounds very specific, like someone in the audience owns a gardening business. If anyone's got more questions, I think keep them coming through. There's another one here that I'm going to answer now, but please do keep them coming because we do still have time. So take advantage of the opportunity. So this question is around structuring considerations. And the question is whether or not we use earnouts or convertible debt, and what the terms of an acquisition might be when actually looking at the valuation. So I think there's a very, very important distinction here between what a business is worth and what a deal might look like. Those two things are very different. What a business is worth is unrelated to how someone goes and funds that acquisition, for example, or whether or not they are going to use earnouts, etc. That becomes a negotiation. So what we do is we try and do a reasonable financial valuation. And what that means, and that sounds stupid, isn't every valuation a financial valuation? There's a difference between a financial buyer and a strategic buyer. And a strategic buyer may well be willing to spend a lot more on the business because there are other benefits that they can get from it that we do not take into account, that we cannot take into account, because that becomes very specific to the business and the buyer. It's important to understand that there are a lot of nuances there that would make a strategic buyer more interesting potentially than a financial buyer. Even in those scenarios, financial, strategic, or otherwise, they may go and introduce earnouts. They may say, well, we want to de-risk it. That would be common, actually. regardless of what the valuation comes out at, I can almost guarantee you, as a seller of a private company, at some point the acquirer is going to say to you, listen, I'll pay you a portion of this now, and the rest of it over 3 years, subject to you hitting your earn-out targets and the following 3 milestones, whatever they may be. That is extremely common. We don't take that into account because, again, we can't standardize that because we don't know. We don't know what the acquirer might come in and look at. And it doesn't affect the valuation. It affects the timing of the cash flows, and it affects the risk in the deal. When it comes to convertible debt, so our online valuation does not have questions around convertible debt because, remember, we've tried to build it in a way, we've tried to balance user-friendliness against being absolutely accurate. There are not a lot of companies out there sitting with convertible debt on the balance sheet. Where there are those sort of complexities, we would then encourage someone to rather do a concierge with us so that we can actually understand those complexities and have a look at what the potential dilution of equity might be, on what terms, what does that mean for the value of the business. So I hope that answers the question. Just important to understand the difference between the valuation and the sorry, I'm laughing at one of the comments. I'll tell you why now. The difference between the valuation and the structuring of the deal. Our gardening man is actually not a gardening business enthusiast, just an interesting SME example. I agree. I enjoyed that example a lot.
Guys, I mean, that might be a question to the Syft team that's come through is, you guys are dealing with a lot of accountants, but also entrepreneurs, so to what extent do you find that the expertise around the numbers in small companies lies with the accountants versus the actual owner entrepreneur themselves? So are you seeing that entrepreneurs are getting their hands dirty, or are they relying on the accountants to actually interpret the numbers for them?
Yeah, that's a great question, Graham. And I think it's, I can maybe just touch on some of the nuances that we see in the different territories that we deal or where we have clients, and that might give some reasonable context. So I always find it quite fascinating that, so if we start in sort of the Far East in our Australasian market, or what we call our ANZ region, so really our Australian and New Zealand clients, there's an interesting dynamic there. They're super sophisticated. And so, whether we're talking to business owners or accountants, everyone's very much on top of the numbers and looking at forecasting. They've all adopted cloud accounting software, and the idea of forecasting and accountants providing advisory services as opposed to compliance services to their clients is quite advanced and quite well understood. And so there we see business owners very much hands-on, very much engaged in the platform. And so there's a combination, if there's an accountant that has a business owner that's using Syft, they'll also invite the business owner into the platform, and they'll actively be using the software and getting stuck into the numbers. And so I think that's an interesting one for us, by far our most sophisticated client base. If we start sort of moving west and we kind of land on South Africa, UK and EU, there's very much a sort of compliance focus still, I think, from an accountant perspective. And so the accountants sit with more of a financial accounting view, where what we're trying to do is obviously drive more of a management view with Syft. And I think the management view is when you start touching on more operational items and more of kind of the data that leads to decision making, as opposed to just looking at P&Ls and balance sheets. Yeah. And so there, it's still around, I think, very much the accountants or the custodians of the financials, and the business owners are kind of, they still agonize over the same things that the guys would in the Australasian regions, things like cash flow as an example, and working capital management, but they may be not as used to getting their hands dirty in the detailed analytics. Examples would be where the Australian clients are really diving down into their sales metrics and looking at their distribution across their clients and their or customers and products, and trying to understand all their concentration risks and how all of these things ultimately impact their valuation. We still see that that's a journey that guys in, I'd say center earth are still going through. And then sort of far west, the American market is just a complete mixed bag. And so we always laugh because desktop, for us, a key financial input into Syft is accounting software, analytics. And so there, it's still very much desktop dominated. I'd say probably around still 70-80% of the market still using desktop solutions. And then that kind of sort of trickles down, the accountants then again are still very much compliance focused, very much just around, tax and statutory returns. And then customers are, there's this level of consumerism where guys just want to buy a myriad of tools and try different things out. And so we kind of, it's almost quite difficult for us to figure out, what the business owners are looking at there. Some of them are so backward, they're still importing trial balances into Syft, and some of them are building these, most sophisticated forecasts. And so kind of a mixed bag for us, but yeah, quite interesting. It's kind of counterintuitive to what you would think. We always think that US is this big glamorous market and everyone's on top of their numbers and they're using sophisticated forecasting tools, but that's actually not really the case. So yeah, hopefully that gives you some sense.
Right, and then maybe there's a question, Jodilee, and you can answer it together with that. But I think it comes from Dylan. Maybe some of the examples, where Syft provides sort of visuals or analysis that maybe some of the other, I guess I wouldn't say competitors, but sort of the accounting packages themselves. And maybe you can also just explain how it works, with the Sages and the Zeros and that of the world. So maybe you can just spend a minute or two on that, Jodilee, and then I'll keep quiet and let Ghost take back over again.
No, awesome. Thanks for that question. So I think that does link in nicely with what I wanted to add. So I think obviously talking about valuation and growth and the global aspects in this webinar. So Duran's kind of touched on how, it's working all around the globe. And I think what we kind of driving is that understanding, like business owners know their business, and accountants have often this like financial knowledge, and they should be working together because all of the things we look at in terms of analytics should be the things that are driving the growth. I know you spoke about things like customer dependency when the Ghost looked through the roadmap, and that's something that we do look at in Syft. So for example, we have a graph that tells you your customer dependency, which customers, you sell the most to, and stuff like that can really kind of change the value of your business, because all of a sudden, if you lose your biggest customer, your whole value of your business has dropped, your future sales are less. So I think kind of the point of all this analytics and accountants and business owners working together to not just kind of be running the business and not to just focus on compliance can really drive value in a business. And I think that's really important. And then just how kind of Syft works. So Duran mentioned in the beginning. So if you have accounting software like Sage, you can connect your entity to Syft and it'll pull through all that information. And then we provide reports and visuals. So Sage and Xero and QuickBooks, all of them, they do have a level of financial statements and visuals, but ours are really just next level. So we have a lot more operational data. So what's quite different with us to our competitors is we bring through transaction level data for the cloud-based systems. And so what that means is we can go and tell you, who you sold the most to, which is your most popular product. We don't just tell you that financial information. We also have like an audit tool. So I think it's probably best to kind of show you lots of examples of it. And I think, we can check it out. But Sage definitely does have some visuals, but ours just kind of give you we have a dashboard which has a nice overview which tells you exactly how your business is tracking all the time. So it's really just giving you kind of all the tools you need to understand your data and then to report on it.
Great, thanks, Jody.
Graham, there's a question here that I'll grab around selling a software and services business, but it's a great question. I must say it applies to basically anything. So the question says, in a software and services business, I've always been of the opinion that it's difficult to find a buyer to see the value that the owner is able to extract over, say, the next 5 to 10 years. Can I comment? Yes. Welcome to deal making. That's how this works. So, every seller wants to sell a business, right? And get paid for, this is what I would have done over the next 10 years. However, I'm going to be playing golf in George and you're going to do it. Now that's fine. But the investor is then saying that's cool. But if I'm going to do it while you're playing golf in George, then I'm not going to pay you entirely for that privilege. Or alternatively, show me what you've got. We can do this over the next 10 years. Let's do an equity deal where I now take, half the equity, and we agree on what the valuation multiple will be on the rest in years to come. And we have an option structure that allows me to take you out and progressively get you to golf and me to wealth in one transaction. I'm obviously being a little bit cheeky, but that's actually how this works in practice. That's exactly how this works in practice. And you could see it with something like the transaction capital We Buy Cars deal. Very, very, very good example. It's various tranches to that transaction. As the parties learned to work together, more and more equity came through. And I stand under correction, but I think the final structure is that the original founders of We Buy Cars still hold something like 10%, or will still hold 10% in the business once the next tranche is done and transaction capital is done with some of its current wobblies. And the point there is they can then choose to hang on to that last little bit of the business, or they can actually get out, or we'll see what they agree with transaction capital. But the point is there's been a whole lot of bespoke arrangements there around different equity tranches. So that's the point around distinguishing between the value of the business and the terms of the transaction. The value of the business is one input into that negotiation. It's just how it is. It's like negotiating with your kid for pocket money and what they're doing this holiday and where they're planning to go. That report card, their marks, probably just one part of the negotiation. It's also about a whole bunch of other things and how well the parents and kids manage to negotiate. And I think that's such an important point to remember. And it's a frustration for business owners, and sometimes they take it personally. They get someone who comes in and makes them an offer and they go, oh, that's absolutely ridiculous. I'm going to make way more money than that. To which the correct answer is, well, then do it. And the seller goes, well, okay, yeah, but it's a lot of work and I'm done, And that's where the problems start ultimately.
Great. I mean, maybe just to start closing out, and I think, to Duran and to Jody, to maybe final thoughts on the matter. I mean, just taking it back to the sort of global level, okay, is there anything else you want to share with our audience, just in kind of closing, taking a global lens on analytics, business valuations, maybe an interesting anecdote or something you've come across, across your global businesses, and then I think, Ghost, we can close out from there.
I think just from my side,
Cool.
Sorry, Duran, I keep butting in. So from my side, I think, I think it's a good fit from a Syft side or an analytics side. It's all about, while you're still, busy running the business, how can you use that data to grow your business better and faster and get the data to make those decisions. And in terms of a story, we had a case study with a client in New Zealand. They were an accounting practice, and they actually take businesses that are like no other accountant wants them because they are going under. That's kind of their fate is sealed. And they take these accountants on. Sorry, I think my internet is shaky. They take these businesses on and they kind of use the information and analytics to help them make decisions, to budget, to manage their cash flow better. And like the times that most of the time they can actually turn these business around and make them profitable again. So I think it just shows the power of knowing your numbers and using that to kind of go forward can really help you grow the value of your business. And that's from my side.
Cool. Yeah, I guess just from our side, in terms of, I guess the whole valuations theme, what we are seeing more and more often in report packs, whether they're produced by businesses or accounting practices on behalf of businesses, is that a key KPI for businesses is actually the value of the business. And so I think there probably hasn't been enough work sort of drawing a correlation between all the underlying drivers that the Ghost was talking about at the beginning. And, that's kind of our focus, is to help businesses improve those metrics and monitor them on an ongoing basis and kind of unpack those metrics. But how does that all tie in then ultimately to the value? And so I think there's a lot of scope to kind of link the two worlds. It's like, almost getting a sense of, when I move these key levers, what influence does that have on the value of my business? So I think, if we could kind of merge our two worlds is kind of my thinking. I think there's a lot of value there because, we seeing this come up more and more often in all of our conversations. And I think that's kind of similar across all the territories that we operate in.
Ghost, any closing thoughts from yourself?
I think just from my side, it's been really cool to see over the last few webinars some of the questions coming through. And I think this kind of momentum that we started to build in terms of, people understanding really complex things, ranging from due diligence through to the difference between financial and strategic investors and how these things are structured. And of course, on the global scale, a lot of the principles are not different. Valuations are really complicated, but in some ways they also aren't. And I think that's how we've managed to build what we've managed to build. And if you understand the key principles in these things, you can apply them anywhere. It's really just numbers and a discount rate and common sense. I'm now way oversimplifying something, but that's the reality. And that's why, if you understand how to do deals in South Africa, you understand how to do deals elsewhere in the world. Yes, there are local nuances, But amazingly, a lot of the principles are similar. And that's something that I particularly enjoy. And of course, that's why you can invest anywhere in the world, privately or publicly. And, finance travels well.
So yeah, in closing, I mean, firstly, I'd want to extend a massive thank you to our two guests, to Jodilee and to Duran. And obviously all of you in the audience, thank you for spending some time with us today. I think going forward, if there's any specific topics, as we said before, that you'd like us to cover in the future webinars, please let us know. Drop us. Our details are on the screen. Let us know. I'll be, as I said, in at the Accountex conference over the next couple of days. I'm having lots of conversations with entrepreneurs from all over the world, UK, Canada, Australia, and so what we're going to be putting out is just some of those insights from those conversations. Keep a lookout on our newsletters, across our socials. And the idea is really to kind of bring these insights to you, to our audience. And so thank you for joining us today. I think just remember that the webinars are available on our YouTube channel. So please feel free to share these with families, friends, colleagues, and I don't have to worry about load shedding this afternoon. So that's one benefit of traveling. But again, thanks to our guests. Guys, everyone have a fantastic, fantastic afternoon.
Thank you so much for having us. It was lovely.
Thank you, everyone. Thanks, Graham, and good luck at the conference.
Ciao.
Thank you, guys. Bye-bye.